You can pay Amazon $22 to get this book delivered to your house. It was just called by a friend of mine who just bought it, the Bible of Real Estate. And it could well be the Bible of real estate. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into some capital growth concepts coming out of really where the convergence of the first home buyer scheme introduced by the federal government is coming into play while rates are dropping and supply is low. Is that a little recipe for some capital growth in the marketplace? Let's have a good chat about that, because certainly when I peer over the immediate horizon, it does seem like we're headed for higher prices, which of course means capital growth. But hey, welcome back, regulars. Play the program in double speed, get your life back. And all the episodes I've done are lessons on real estate. So feel free to go back in time. And yes, I still have my man cold because I'm recording this episode the same time I recorded last week's episode, which you would have listened to last week. As you know, I'm on pseudoephedrine. I'm on speed. I'm trying to dry up the nostrils. And of course, between the pseudoephedrine and my new book, my life is just a buzz. And yes, I will mention my new book once again. It's called The Australian Property Game, and it's available on Amazon. You can pay Amazon $22 to get this book delivered to your house. It was just called by a friend of mine who just bought it, the Bible of Real Estate. And it could well be the Bible of real estate. If you like the idea of investing in design in real estate on your real estate investments, doing a renovation, tackling rental yield strategies, even digging into tips to being a good landlord, and going even deeper into things like the fire economy, you can get yourself a copy of this very heavy book. It'll certainly help you when it comes to real estate investment. And because the book's really the first print, there's the odd little error in it. And if you find an error and you tag me, I can readjust the book on the Amazon settings. So the print on demand fixes the error. But hey, check it out. It might help you with property investment. And a big part of my journey is just simply talking about real estate these days. I've been involved in real estate a very, very long time. And a big part of my journey is analyzing what's going on in the real estate world and, of course, tackling some real estate investments firsthand. But I think it's a worthy conversation to talk about really 3 points of the system coming together. You've got a massive housing supply shortage, and really there's some pretty grim predictions of around 400,000 homes that are not going to be delivered by 2029. And 2029 kind of sounds like a far away place, but really it's not that far away whatsoever. We're talking 4 years' time. There's just already not enough inputs going in to create an output effect of over 400,000 homes not being produced. And of course, if you keep increasing your population and you keep underbuilding, really the market responds to that by having to pay more for real estate. And what we do see from some figures, ABS building data, is it's taking a longer time than ever to develop new properties. If we look at houses, on average, it's around close to 11 months, which is a lot longer than it was back in, say, 2014, where it took basically 6 months. Townhomes are taking 13 months to build and bring to market. Back in 2014, that was just 9 months. And apartments, well, they are the hardest dwelling type to bring to market in a speedy period. It's almost taking 28 months to deliver an apartment from start to finish when it comes to construction. And of course, if we go back to 2014, basically 11 years earlier, it was taking 18 months to bring an apartment to market. So we are not productive. And there's actually some figures that came out that said our construction workforce is well paid. It's the second most well-paid workforce in the world when it comes to construction, but actually it's the fourth least productive. So I'll let you analyze that data, but we're certainly struggling to produce. And I think it comes down to ultimately there's just not enough construction workers in the system to produce the output we need. It may not be a reflection of the actual individual construction worker working hard every day, battling the elements to bring construction to the marketplace. But simply, if you don't have enough construction workers, you simply are not going to be productive, and Australia is just not productive when it comes to producing its product, particularly the built form of apartments. And when you think about housing, high density and density done right is a critical piece to delivering those missing 400,000 properties. So if we're going to be 400,000 properties down, and of course we continue to increase our population through population economics, through the idea that we need to bring more people into the economy to keep stimulating the economy. If we didn't have more people in the system, we effectively would probably be in a recession, but we kind of avoid recessions because we bring people into the economy, which creates more people to sell stuff to. When you've got a services economy, it's really how the system kind of works. So you've got lots of people, not enough product. That is a metric of supply and demand. And of course, the next real metric is money, the cost of money. And it's fair, we're now in a period of time where the interest rate cycle is not going through a interest rate rise. It's actually going through an easing cycle. So we've just had some rate cuts, and no doubt there will be more throughout this year and potentially early into next year. The economy is not growing, and that means the cost of money will come back down. And as inflation's under control, that will certainly mean there really is no reason to leave money as high as it currently is, albeit there are some geopolitical tensions and things that happen overseas, which can quite often throw things back. But if we look at the last rate easing cycle, or where there were rate easing cycles of 2 or more cuts within the cycle, we can go back and track what happened to the real estate market's prices. In 1984, there was an easing of real estate, the cash rate, and the real estate market went up by 6%. In 1986, you had rate cuts and the real estate market went up 11%. In 1988, you had rate cuts and the real estate market went up 60%. In 1992, 5%. In 1998, 15%. In 2003, 32%. In 2010, 15%. 2013, 13%. 2017, 12%. And of course, during COVID, 27% in the rate cut cycle in 2021. So obviously, we've had rates go up, and now we are having rates come down. And obviously, there is a correlation between how much capital growth happens when rates come down. Even though rates come down generally because the economy is not doing that great, there is a correlation in capital growth. And really, the correlation is every 0.25% rate cut that is pushed through the system equals around 2.5% capital growth. In other words, if there's a whole 1% rate cut, there's going to be 10% capital growth in the marketplace. Now, that may be spread out over 12 months, 18 months, depending on how long those rate cuts take, but there will be capital growth off the back of the rate cuts. That is without question going to unfold. If you've got two people, they can borrow the same amount because of what interest rates cost, and all of a sudden they can borrow more because effectively interest rates have been lowered. They typically spend that extra money. You don't typically have two people at an auction where a property is put up for $1 million and one person's got the ability to borrow $1,050,000 and the other person has the ability to borrow $1,050,000. They generally spend $1,050,000. And if interest rates are going to allow people to spend more, that spending will unfold. That spending will correlate into capital growth. And really, there has been periods in the past where rate cuts have led to capital growth. There's a lot of evidence around it. So if we think about where we started, we've got no supply or the lack of supply. We've got continued population growth coming into the country. The immigrants that came in 2021, it's now 2025. They will go through the visa system and pop out as permanent residents capable of doing business in the real estate marketplace in 2026, 2027, 2028. And of course, some will become citizens. That system is literally, if you go back to where the population stats went off the chart, it really is all the way back when in 2023 and 2024, we had over 1 million people come into the country, many of them remaining to be permanent residents. So the future outlook of just those people becoming, leaving the rental market and becoming home buyers is quite huge. They should be effectively off the back of how long it takes to do a degree and become a permanent resident in Australia. You should see later in this decade a lot of people coming into that system. That will obviously time where there is just not enough properties meeting the 1.2 million well-located homes, which, of course, by the numbers that we're tracking, we're already 400,000 off track. Then you've got the interest rate cycle, which is dropping, and the Commonwealth Bank predicts by December 2025, the cash rate will be as low as 3.35%, but mid-2026, it'll be around 3.1%. Westpac has the cash rate mid-2026 at 3.25% and NAB at 3.1% by February 2026. That means you're typically going to be borrowing money at about 5%, 5.1%, which is means a lot of people are going to have more ability to spend more to get into the marketplace. And again, if you think about where the cash rate began, well over 4%, and where it's going to end up at 3.1%, you can apply a capital growth rate to that drop in the cost of money. And again, you will see real estate ultimately be the beneficiary of that when it comes to price movement. But again, another big driver of demand, like we're going to need more demand, is Labor's first home buyer policy. Now, again, Really, we need supply. We don't need demand to keep properties affordable. But arguably, Labor's first home buyer policy is going to really wipe out affordability. Obviously, it's going to help people get into the market. The aftermath of that, well, we'll just have to review that down the track, but it may push property values up quite high to the point where actually there could be an undermining effect of most investors being unable to become an investor because real estate prices are just out of reach for them. Obviously, it might help first home buyers get into the market. Over 100,000 first home buyers coming into the market off the back of the first home buyer policy, which allows for a first home buyer to put a 5% deposit down. Basically, their income isn't an issue, what they earn for a living. They can put 5% deposit down and they can go shopping in the marketplace. And of course, there's 100,000 spots for them. 5% down, they can avoid lenders' mortgage insurance. Now, if they can find the right property at the right price by virtue of their capital city, in Sydney, the price limit for the scheme is 1.5 million. In Melbourne, 950. In Brisbane, 1 million. In Adelaide, 900. In Perth, 850. There's lots of product which is circa that price point or just below, which both investors love because the yield variation works for them as an investment, i.e., you can buy a house in Melbourne for $750,000, you're going to get $650 a week in rent. The challenge moving forward for the investor is the first home buyer is going to get into that property easier than the investor. Now, think about it. Let's say an $800,000 property in Brisbane. The first home buyer is going to need 40 grand to get into the market. 40 grand. They'll probably avoid stamp duty or pay less stamp duty to the state government as well. So they're not going to need a lot of capital to get going to get into the marketplace. However, the investor, maybe they're shopping on an 80% LVR, that same $800,000 property. They're going to need a lot more money to buy that property. They're going to need $160,000 to buy that property with a 20% deposit plus stamp duty. It probably takes them up to $200,000 of either cash or equity to buy that $800,000 investment, as opposed to the first home buyer who's going to go up against them with a $40,000 deposit, basically as the only capital they need to get the deal going. Now, again, there's over $10 billion set aside for 100,000 first home buyers to come into the marketplace. And of course, that's a bucket load of people that can get into the marketplace. And of course, in general terms, that's going to push up the value of real estate. That will push up every property that's worth just under the value proposition of the scheme. It's going to go up in value. If you put that amount of people into the market all at once, you're going to see a stimulus of price movement. Now, correlate that with no supply, no stock, excess people that have come into the country that will become basically first home buyers, the first home buyers themselves, and rate drops. If you put all of that together, you without question will get price movement. Now, again, it's a strange time to load up demand because demand is generally not the problem right now in real estate. Certainly saving a deposit is a problem for young people, but demand is not the problem. Generally, supply is the problem. Obviously, if you could fix supply and then add this scheme to it, you would get yourself in a situation where it's more of a balanced, affordable kind of model, which allows people to buy the real estate, but allows the market to create affordability. really what I think you'll see off the back of these three pillars coming together, being low supply, the cost of money dropping, and a new wave of buyers coming to stimulate the property marketplace, is higher prices. And really, if you look at where those prices could end up, it's Sydney's medium house price after this wave happens could end up 12% higher. There's a lot of prediction to say this will all take the real estate market 12% higher. You've got Sydney, which will end up with a house price prediction of 1.9 million effectively, Melbourne around 1.16, Brisbane about 1,150,000, Adelaide well over 1.1 million, Canberra well over 1.1 million, Perth 1,027,000. And again, all of that is going to do something to society. It's going to create wealth for those people who've already got wealth. It's going to reward people who've got capital into the marketplace. It's going to reward those first home buyers by getting them into the marketplace on little to no money. But certainly the aftermath of that should create a society, and you have to argue, is this really a narrative potentially that is going to create a society of just renters and build to rent? Will it actually eliminate property investors from investment by virtue of price delta? We're already seeing, for example, Brisbane's median apartment price is $700,000. A lot of investors can't afford that. And again, if you start to eliminate investment because prices are too high, you end up in a place where government needs to provide housing. And really, that is often referred to as social housing. Really, I don't know, from a conspiracy theory point of view, I've got, a take on it. I won't dig into that take today. But certainly, if you're an investor and you're stuck with moving, or you're sitting on the fence, or you're, just procrastinating, you better start getting into it, because I think you've got the rest of 2025. Certainly, you've got all the way up to mid-2026 before that wave of first home buyers come into the marketplace. So by this time next year, you'll have low rates and lots of first home buyers to compete with. That will push up property values. And if you're not taking action, you're going to miss out. You'll miss a wave of growth coming to the marketplace. So don't miss the wave. As an investor, you'll always want to be invested to catch the next wave. There will be growth. I can't see why there wouldn't. If you look at that evidence, if someone's got a different opinion, I'd love to hear it, but I just don't think you're going to not have capital growth off rates dropping, a new wave of investment through new synthetic demand created by the government through the first home owner grant, and really just not enough properties being produced. So I'll let you guys ponder on that. Thanks for your time. I'll catch you on the next episode as we talk more real estate. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.